People often say that a solid trading plan helps you to grow your account, but that is not all. See, you need money and risk management to help you survive in this financial market. You can have a solid plan without money and risk management, you will blow your capital. So in this video, I will be discussing some of the best money and risk management plan that will help you minimize risk and effectively grow your account. I will also be demonstrating some of the techniques on how to open positions, control your emotions, and of course, that will allow you to catch some insane risk-reward ratio in all your trades. If you are ready, here are what you are going to learn. What is risk and money management? 2. What is position sizing? And the third one is money management techniques that I've applied in all my trades and that have sustained me in this journey. So risk management involves identifying and minimizing potential risk in the market, while money management focuses on effectively allocating and protecting your trading capital. You see, they both serve the same purpose, which is achieving long-term success, preserving capital, and of course, optimizing profitability. Let's put it this way. You enter 5 trades at a row and you lost all. If you lost all the 5 trades and you lost your entire capital, it means that you didn't manage your money properly and you did not apply a proper risk management. But if you can enter up to 10 trades and you still have some big portion of your capital intact, it means that you apply a proper risk and money management strategy. So let's take some examples here. Say Mexc and Airdrop, they both have a trading account of $10,000. Their trading strategy has 50% winning rate and a 1-to-2 risk-reward ratio. Risk-reward ratio compares how much you are willing to risk on a trade and how much you stand to gain. So let me put it this way. Say you have 1:2. Now, 1 is the amount you're willing to risk and 2 is the amount you're targeting to win. It means that if you're targeting to lose $10 on a trade, you should be targeting to win $20 in that same trade. In case you lose this $10 or you win $20 later on, you are still on profit. So it means that your potential loss should be lower than your potential profit. Let's take Mexc and Airdrop again. If Mexc risk $2,500 per trade out of the $10,000, while Airdrop risked only $200 from that $10,000 trading capital. And then the outcome of their trade is straight 4 losses and straight 4 winnings. What it means is that if Mexc enters 25 and lost the straight 4, he has lost the entire $10,000, which is this amount. So his balance is going to be 0. That is lack of proper risk management. Whereas if Airdrop is going with $200 and she same trade and she lost the 4 straight row and then had straight 4 wins, $400, total of $1,600. If you deduct the $200, that is total of $800. It means it's going to be 16 minus 800. I might not be writing this properly, just manage it. It means you're going to have a total of $800 profit. So this happens only when you apply a proper risk management strategy. So if you look at the both of them, you're going to see that both traders have a both winning strategy. What happened is that losses came first before the winning. And if that happens in your trade, it means that you're already out of the market. So basically, risk management involves identifying and minimizing the risk of possible future scenarios like this one. Let me further take you to a chart and let's apply this inside the same chart. Now, let's start with the risk management path. This is a trade you want to enter. And you look at the market, this is your buying position. And then here is your stop loss. And then immediately enter the trade. The market starts going against you, coming close to your stop loss, and finally hit your stop loss. If you're targeting to lose only $100 on this trade, let's say you enter with $1,000, you've lost $100. And then if your target here is $200, it means that whichever one that happens first, you are going to be on a profit. But before you do this, you should be able to know how to analyze the market properly, and you have 70 to 80% chance of winning. It means that the losses that be coming are inevitable because you're not in control of the market. However, if this happens, you should not lose more than what you are targeting to profit. Now, let's take it this way. Take for instance, you enter the trade, right? And then the market went straight to your entry of targeting $200 here profit. Now, if I were you, your stop loss should be at your entry position. In this case, it means that you have saved your capital because you're a careless trader. However, you're supposed to set a trailing stop. If it didn't hit your target, maybe say this is your target zone right here, and it didn't get to this target you are looking at, and you see it going up. If you're not certain of the market direction, if it's going to hit your TP, all you need to do is to set a trailing stop. Keep setting a trailing stop that if this thing breaks down, or you can come and set a stop loss close to your profit entry. If this thing breaks down here, you should take profit. With this, you've risked little of your profit and you have also saved your capital. This is how to apply risk management in your trade, irrespective of what you know. Even when you think you are an expert, you are not going to lose a trade, you will definitely lose one day. So make sure you apply a proper risk management, and that is the essence of this video. Let's continue with the rules, concept, and calculation of money, and of course, capital management. But this is going to bring us to this question: how much should you risk per trade? The answer to this question depends on your risk tolerance or appetite. Your risk tolerance is the amount of money that you are comfortably losing when you encounter inevitable losses in your trade. So we have risk tolerance per trade in capital. Ask yourself this question: what amount of capital are you willing to risk per trade that when you lose this money is not going to affect your emotion because the market didn't go according to your way? Or if you have a bad day in your trade and you lost 5 trades in a row, how much of that total that will be leaving your capital and is not going to affect your future trading decisions? Depending on the answer to these questions, you can build a solid management plan. But if you look at the last slides that I showed you, I've already explained this. But let me break it down by explaining what is position sizing. So what is position sizing? Calculating position size depends on the percentage you are willing to risk, your account size, and the number of stop loss. Risk 1% of your capital on each trade. This is a standard trading rule. But for me, I can tell you, you can do up to 1 to 3 depending on your risk tolerance. Let's take for example, you still have an account of $10,000 and you are willing to lose $100 on a trade. Position sizing simply means the amount to risk and stop loss amount. If your trading capital is $10,000 and you choose to risk 10%, which is $1,000, and you have 10% stop loss of $1,000, which is $100, how much should you be targeting? You should be targeting to take profit of 20%. It means that if you are willing to risk $1,000 out of $10,000 per trade, and you are willing also to risk 10% loss from your $1,000, which is $100, and also willing to take profit from 20%. Now, if you lose 4 straight trades and then win 4 straight win, you are still on profit because $100 multiplied by 4 is $400, and 200% of $100 is 200 multiplied by 4 is 800. At the end of the day, you are still on $400 profit. If you risk more than you are willing to lose in a specific trade, your emotion will control the outcome of that trade. Let me summarize this again. If you risk 5% per trade and lose 5 straight losses in a row, you have reduced your capital by 25%. Why not risk at a smaller percentage of your capital? Because the amount on each trade determines the amount of gains and losses as well. Please, your money management plan should be such that wins encourages you to continue and your losses do not stop you from trade. Now you've learned how to calculate the position size in your trading pair. Let me show you my money management techniques. 1. Enter trade in tranches. Entering in tranches is splitting your entry position capital in different positions. Let's take for instance here, you have a chart that is this way. I might not get this the way you want it, but then I'm going to mark. So you can choose to enter your first $200 here by splitting the $1,000 into 4 by 4 places. So you put the first $200 here, second $200 here, third one here, and you can put the last one here. So if the market enters here and breaks down, is going to hit the second entry, breaks down, fourth entry, and comes to the fifth. There is no way the market is not going to reverse between here to this point. So entering in tranches is splitting the entry amount in different positions in your trade, and this helps you to also minimize your loss. Then the next one is transfer your money into another account. When you've made profit in a particular trade, please learn to remove your capital. Say you started with $10,000 and this money has grown to $15,000. Now you might be tempted to increase your entry capital from $1,000 to $1,500, but removing the $5,000 profit is going to help you maintain your trading routine until your capital has grown so large. And then the next one is try to withdraw profit monthly and invest in other businesses. So you can withdraw your money monthly and do other stuff. You can get yourself a car, you can get yourself a house, you can go into other businesses, because sometimes the market might not really give you what you want at some time. You might be off the market for weeks and months. At this point, other businesses can be running for you. And the fourth one is invest more in developing yourself. You see, a lot of people, after learning the first strategy and is winning for them, they choose not to develop yourself. You need to keep learning and you need to keep developing yourself, and this is the best strategy that is going to keep you remain profitable in this market. The fifth one I'll be recommending for you is try and explore the world. Look at today's world. Look at the forex traders, the top forex traders. They like to explore, meet with people. Life is once. Enjoy it while it lasts. My name is Gibchain. This is risk management class I've given to you. If you didn't really get it, go back, watch the video over and over until you start applying these principles. You will be a profitable trader. See you again next time.